That was a big week.
Huge week. Huge week. Kicking off with Cut Through Ventures report, the state of investment landscape in 2023.
Yeah, it was a really good report. We touched on total funding, and then we touched on just the medium deal sizes and go into a number of other topics such as VC funds, angels, founders. And there's a lot of themes in this report which they've expanded on from last year.
I really love the way that they gave their summaries and then really went deep into the topics. But just a mammoth effort, absolute shout out to them. And then there was another report released by Cake, who's one of our portfolio that we're proud to be involved in. And that was talking through the state of equity granting in Australia. And there's some really interesting stats there. Equity can be incredibly valuable. And we talked about what Elon's been able to achieve by using equity.
And that led us into a little deep fake fraud with a deep fake conference call defrauding a company of 25.6 million and why we need a safe word.
And then we discussed Adam Neumann plotting to buy back a WeWork.
Amazing. You think that was an AI generated comedy headline. We also discussed that Atlassian reached the 3 comma club and what Atlassian has done broadly for the ecosystem.
Yeah, the 3 comma quarter club, quite an achievement. Then we talked about some companies doing not so well, and we talked about Touch Ventures, not Torch Ventures, as Don thought they were aptly named.
Torching the capital.
And then we rounded out talking about the B2B market segment and the B2C cycle and how that might come back through.
We also touched on the Apple Vision Pro and discussed how Don's looking forward to getting the headset on.
I am not above looking like a wanker.
Busy week.
Let's just get into it. There's a lot to go through today.
Far out, there's a lot happening.
But before we get to that, how have you been?
Bloody awesome. Things are good.
I feel like it's been days since we've seen each other.
Yeah, 24 hours without talking starts feeling weird.
And Jack, you're sitting there with a T-shirt, so weather's good?
Yeah, it was pretty fresh this morning, but the sun's up now.
Nice. You're hitting the beach on the weekend?
Yeah, I was at the beach all weekend. It was like perfect weather over the weekend.
Yeah.
Enjoy it while it lasts, Jack.
Yeah.
As were you, Aaron?
Yeah, it was a nice weekend down the coast. Weather was amazing. The water temp this time of year is just sensational.
I went for a swim at Noosa Main Beach and it was like a bath on Sunday morning.
Yeah, right.
5 a.m. was just a bath.
Like a good bath or a bad bath?
No, good bath. Just floated there, floating around in the calmness, watching the world go by. It was good. It was a good bath.
So good. Awesome time of year.
We should probably start with the Cut Through Ventures report because that piece of work is massive. I think it's incredibly valuable to the ecosystem. So absolute shout out to those guys. Yeah, I think maybe do some quick call outs, but I think we'll just pull it up and just go through it and discuss the favorite bits.
Yeah, amazing report again. Like always delivering the quality, and this time I feel better than ever. Just the depth of insights, and for founders that may not have seen it or they just saw the post, I definitely encourage you to read it. It's good to understand what the markets are doing right now and also the sentiment of other founders and investors. So absolutely well worth the read.
Yeah, let me pull it up. Of course, a professional podcasting group would have all of this shit ready before they hit the record button.
You know, if we had resources, we'd have that person supporting us that pulls up all the visuals while we're talking.
Yeah, like on the cool podcast, and they always have something funny to say, or they add in a little bit, or you take the piss out of them. Firstly, Rain Ong, he's become lippy.
Oh,
have you seen his recent posts?
He's really so good.
I love it. It's like VCs congratulating themselves, but from within. It's like taking down the team. But yeah, I liked his post this morning that it looks good. AI made it less boring.
He's been on fire the last week in particular. Some of his content has just been genius. I absolutely love it.
Has he always been that way, or is this a new?
Always been entertaining. Always a great perspective. But yeah, there was I can't remember which post it was. There was one I was reading recently, and I thought it was serious at first. I'm like, oh wow, where's this going? And then I realized actually this is satirical.
It's like calm down. But yeah, good graphics. So it reinforces, I think, everything we've been talking about, which is investment is down broadly, which makes sense. And when we say it's down, it's renormalized.
Yeah.
It's now it has in some areas the pendulum swung too far and we'll see a bounce back. Absolutely. That's just the pattern that the world produces. You swing in and out of equilibrium. But yeah.
Yeah. So some broad numbers that I took from it. Total funding for the year, like year on year, was down 54% to 3.5 billion Aussie with 413 deals. And what was interesting was the number of investors decreased down to 373 investors that made those investments. And another interesting one was only 16 investors made more than 5 investments last year versus 35 the year before. So
Say that again.
so last year, 16 investors, only 16 made more than 5 investments.
Okay. So this excludes angel investing.
So that particular stat was the funds side.
Funds. Yeah. I think what this report highlights is actually professionals, not the right word, but angels, as in you're an actual angel investor. You're not a tourist that came for a couple of years hoping to make some sweet bank and then fuck off when the world didn't go your way. Angels keep investing. Their checks may not be as big, but they're certainly investing.
Yeah, and really the backbone of the ecosystem at the moment. But yeah, like there were lots of good stats in there. Continued decline since 21 was the broad brushstroke, but I think overall it actually paints quite a healthy picture, I think. Like the depth, one thing that was really telling was just the number of VCs that contributed. And the angel data, I think, was also really compellingly strong as an ecosystem. So I think overall quite positive, even though the headline numbers look down based on the last, like comparison to the last 2 years.
It's like it feels like the industry's become more of a perpetual motion machine. It's now got that base load of angel investors into small VC, into larger VC. There's the accelerators, there's the hubs, there's the incubators. They feed into different things. Like it's an industry that's now taken a life of its own.
Yeah, I think Justin Lippman's comments, he was talking about we're now seeing domain expertise in the sector and it's really starting to mature.
Yeah, I didn't see that one, but that makes absolute sense. And whilst investment is down and it's normalizing, I think it's healthier. All the conversations we're having, either with existing portfolio or we've got an exciting pipeline of deals come through, I must admit, I think it's the best it's been in since we started. Just that resourcefulness. How do we organically get some momentum? How do we first think about what the existing team can do to get scale before even having a money conversation? I just think it's really healthy.
Yeah, I do too. I'm noticing, I saw a thing the other day saying we're already 10% of the way through the year, which is scary.
Oh, shut up.
But deal flow has picked up massively in volume, but quality. We're seeing really good stuff coming through now and totally back to really good fundamentals, good metrics. And what's interesting for me is you look at the number of investors that poured capital in during 21 at, I would call, crazy valuations, like when you multiply them out of what an exit would need to look like. But now at this time when we have some great businesses, really good fundamentals, and investors have, not all investors, but some investors have pulled right back. And there was a stat in the report that 44% of investors want to invest less into this asset class this year. I find that really interesting. Like, to me, there's never been a better time to invest.
They're going to miss the boat.
So was that funds or was that angels? Because like we spoke on the podcast about some of our high net worths and they've just got so many opportunities right now in private credit and other asset classes, so it's hard to justify.
Yeah, that was angels, but it was pretty much split equal. There were 47% of angels want to invest more in 24 and 44 want to invest less.
Yeah, okay. Yeah, for us, it hasn't been a better time to invest. Like valuations are coming down. As we said, the pendulum's swinging back to being more investor friendly. So it's a great time for us.
Yeah, absolutely. I'd love to find a way to help communicate that there's some great opportunities. And it's a win relationship at the moment. The business and the valuation is of great value, but the founders' mindsets and their learnings on go-to-market and how to actually grow something scalable is also incredibly of value. compared to a few years ago. And so there's an opportunity to really help the founders because they've got, I think, some go-to-market strategies that are actually really connected to reality with a great opportunity. And that will then create some great shareholder value. Whereas in the previous time when there was too much resources, a lot of that money was being wasted. And I was reminded this morning watching TV, which I rarely do, but an ad for Milk Run came up.
Oh, from Woolies.
Yeah. Now, there's no Woolies branding on it. It's just Milk Run as a brand with a value proposition. And unfortunately, those investors effectively created that platform, got wiped out, and now someone's going to do something with that asset.
I see more ads and content for them now than ever before.
Yeah.
Yeah.
No, I think, and on the weekend, contemplating my navel and looking into the future, it occurred to me that with 3 children and education costs, I should probably do a spreadsheet. And I modeled out the next essentially 18 years, taking into account inflation. And the only thing I could think of is each year is how many investments that's being swapped for the children's education. I know I shouldn't think that way, but when you get to the end of the spreadsheet and to put 3 kids through 18 years of certain schools, that's a few venture deals.
Well, a privileged problem to have. We did our family budget for the new blended family, and I don't even want to look at it. I had a trauma. We'll have homeschool for the tribe team.
Yeah.
Homeschooling.
Anyway, we digress. So it was interesting to see. Let's jump into the chart here. One of the things, larger deals grinds to a halt. So it was a disproportionate large deal stoppage.
Yeah, and just for the founders out there that are curious and maybe didn't have time to read it, the median deal sizes were interesting. So pre-seed, median 600K, seed to Series B. The Series B surprised me a bit, but I think you only need a couple of outliers when that volumes declined to really push that figure up.
Deals greater than 50 million. There's a lot of names in there that we know, but a lot of names that I've never heard of. A lot of the ones that I haven't heard of, space and defense and all of that jazz. It's interesting we're into Series E's and Series F's. I guess does the series thing just only end when it lists or gets sold?
Well, I assume so. I think they just...
I wonder, we should research what's the biggest number in the alphabet, and has any firm ever needed to start doubling up letters? This is my Series AA.
But again, it's a good signal for the ecosystem to have that latest. Like if I rewind 10 years, these sort of things just didn't happen in our ecosystem to that extent. So it's a positive indicator.
So then we get to the slide that has sector shifts in popularity. So it looked at the end of 22, halfway through 23, and then end of 23 with certain lines. Health tech sort of has a bit of whiplash. It was in the top 5 at the end of 22, dropped down into the middle halfway through 23, and then into top 4 of 2023. Climate tech, it was number 1 at the end of 22. It's dropped down to middle of the way and then climbed back out to be number 3 by the end of 23. I'm not exactly sure what to take from all of these. The funny one is crypto Web3 dropped to the bottom, stayed at the bottom.
It would have been good if there was an end of 2021 because I reckon crypto would have been top 3 and then it's gone middle of the pack down to the bottom 2 years in a row.
Completely.
Yeah. And Simon Thompson this morning I saw posted on LinkedIn pointing out that it was crypto and all the VCs were all over it like a fat kid on a cupcake. My words, not his. Like, you can't say that anymore. A large child on a sugary treat. And then now it's just AI.
Yeah. Yeah, and we're all the NFT millionaires that were predicted.
Yeah.
Yeah.
So I'm not sure what to take from that. For us, I guess we're fairly agnostic, but we want it to be B2B that's ready to scale to the US and the UK. And so we have a broad range of, I guess, sectors.
Yeah, it's interesting. I don't know what to take from it either. And there's always so much variance in that chart. But what is interesting, like last year, climate tech was way up in the interest level. And it did actually correlate for 23. The most number of deals done was in climate tech. It was 9.9% of all investments. So it is interesting that investor interest does actually correlate through in some way to capital that ends up getting deployed.
Yeah, and I think when I look at climate tech, more recently, there's just some amazing stuff that will actually change the trajectory. Like Samsara as an example. If they can get that product at scale, I know it works, but if they can get it at scale, that's an absolute game changer for dealing with plastics, the oceans, all of that kind of jazz.
Yeah,
You have all of these autonomous robot boat things that go out, pick up the shit, come back, convert it. Like you can just see it now. Does that then give permission to humans to be even more grubby because we've now got a solution rather than changing the behavior? I'm not sure, but
oh, look, I'm sure it plays into it. But we've had 3 cold inbound pitches this week from battery tech and power generation, and it's pretty incredible to see what's coming through.
yeah.
Like phenomenal small form battery and flexible batteries that just have an energy efficiency unlike anything we've seen before. So it's interesting where it's all heading.
Looking forward to it. So continuing to scroll down, we get to the heading incremental improvement for female founders. It's inching forward. 2022 was a terrible year. So share of capital raise and number of deals to founding teams that had at least one female founder, that dropped to 10% of the share of capital raised and 21% of the deals announced. Now that has jumped to 18% as a share of capital raised. So still not back to where it was in 2021 or 2020, but I think that's just because all metrics are down from those prior years. This is a metric that absolutely needs to improve.
Yeah, it was interesting to see that deals into all female or mixed gender teams reached a 5-year high at 26% for the mixed gender in particular, but still, yeah, such a long way to go. But yeah, at least they're coming off the bottom of 2022, which is a positive sign.
Yeah. Who's still a unicorn? New valuations, it talks about who's still a unicorn: Canva, Safety Culture, Go One, Pet Circle. But then there are companies that had no new valuations announced in those years: Octopus, Deploy, Simpro, Culture Amp, Airwallex.
Yeah, Donna, stat that I liked there was it reported that 89% of the global unicorns crowned in 2021 have experienced a valuation decline, and a third of those have fallen below the $1 billion valuation mark. So no longer a unicorn.
Yeah. They were just donkeys with an ice cream cone strapped to their head. I've got to pull my head in. We're going to start getting hate mail. The other side of the coin, VC fundraising activity. Despite the downturn in global listed technology markets, venture capital funds faced Despite the turnaround in global listed technology markets, venture capital funds faced a challenging environment for attracting investments. Absolutely. And I think where it says, despite the turnaround in public, we're a lag asset class. When the public markets start moving in whichever direction, this asset class, because it's a lot more illiquid, it's a lot slower, it takes a while to catch up. My gut feel is we're on the crest of a new push forward we're on the crest of a new push forward in just investment and valuations and all of those things. And that's partly fed by the public markets.
Yeah, totally agree. And I think one interesting thing that's going to play out this year is, so there was a stat in there, 92% of surveyed founders plan to raise capital this year and into early 2025. So all those that have been holding off or using other finance means now coming back to market. So I think there will be a drive. I think there'll be a drive on the deal flow side, but then a drive through the other markets and other investment opportunities that the LPs kind of factor in as well.
And that's why, to the investors listening that may have been burnt a little bit in 2021 and 2022, these companies that are coming to market are just different companies. They can pronounce and know the meanings of profit and sustainability. Like they actually know they can actually see how I'm going to build a sustainable business. That wasn't a prior requirement. Let's keep going. International investors continue to support the local ecosystem. So that was really good. Contrary to widespread commentary, international investors have not abandoned Australian ecosystem. And a shout out to Adam from Octopus Ventures, who was interviewed as part of it. He said, at Octopus Ventures, we are impressed with how Australia's startup ecosystem has flourished over the past decade. The investment we have made reflect the region's tenacious, resilient founders. And I think he's definitely right. And Octopus, since they've started investing here, have done quite a few.
Yeah, last I heard from Adam, I think they're up to 6 local investments.
Yep.
Great team. And it's good to see them continue to look at the region.
Current pulse of Australian deal terms. I found this interesting. 73%. So we'll start again. Does your startup currently issue any of the following types of securities? So 73% ordinary shares, safe notes 44%, pref shares 43%, options 41%, convertible notes 30%. That changes over the tech stack. So angel investing is very much pref at that really early stage. It's pref. Once you get more to proper Series A, certainly in the Series B, you're into the realm of ordinary. And then that middle line, safe notes, are very much a tool of this industry, which sometimes work and sometimes don't.
Yeah, there were no real surprises there for me.
Corporate VC.
This got talked about a lot last year, and how many CVCs wound up or lost interest and stopped deploying capital. So the data on this one was a little more bullish than I expected.
Yeah, those that are proper corporate VCs that weren't just set up as a brain fart, they just continue to do their thing. So then Divergent Investor found a view on investor value. I had an absolute chuckle at this one. I bloody loved it. And let's explain why. Investors believe building a relationship with the founding team was like the number one thing. And the number two thing for investors was the brand, who you are in your fund. Guess what? Only 16% of founders thought the relationship had been built, and only 13% gave a shit about your brand.
Yeah, this one, that was my most interesting. And I can see this play out on both sides of the table. And I saw a post by Jesse Wu on LinkedIn kind of insinuating that, actually the quote was, Australian founders don't seem to rate the brand and reputation of the VC highly. It's 11th for founders, second for investors in consideration. But went on to say, founders should place more weight on the size and strength of an investor's brand. Now, I love Jesse Wu, but I completely disagree on that one. And from personal experience and even chatting to a couple of the others, investors recently, in my view, like the bigger the brand, yes, there's some anchoring for others to follow the investment of a big brand, VC. And yes, it might help you close the round to have a big brand as the lead. But after the investment, the support is less. You're a rounding error if you're failing, you're abandoned. And I'm making gross generalizations here.
That's what this podcast should be called, the gross generalization podcast. So we're 27 minutes in. I assume we've already made 10 already. So let's just keep going.
Okay. But yeah, typically when I've been on calls with big brand VCs, they typically know less about the company. They're more spread across a larger portfolio that they're aiming to support. Those that aren't doing well, they're a small rounding error in the portfolio where they get abandoned. The level of support they provide, like direct hands-on partnership with the founder, tends to be less. And if you look at the returns on capital for the investor side, the smaller funds actually outperform. And now there is a correlation here. I'm generalizing around brand implies time in market, and typically there's a correlation between time in market and fund size. Yes, I get Jesse's point about it might be easier to close a round and get others to follow with a big brand. But I think you've got to zoom out and think more long-term about the value the investors bring outside of just getting your round done.
Like most things in life, there's a nuance. The value they keep talking about is the network to either investors or other founders, and that those networks opened the door. More and more as the VC scales, in my experience, they're not employing operators or people that have previously operated. They're more financial types. And there's nothing specifically wrong with that unless there's not a balance. I believe a good balance. Now, we are not balanced on some items and therefore try and plug those areas where we're not balanced through the right co-investors. So I think you got to look through brand, but I think some of the big brands attract people that our little brands can't attract.
That is true.
And so there is some value at that. But I think some of the little brands, because we have to work harder, I think we are scrappier and therefore look for more ways to try and add value than a big financial brand. And what I laughed the hardest at, so Tribe Global Ventures, the B2B VC that seeks to be in the trenches with you and then help you expand. Now, operational support and international expansion, in the mind of the founders, both ranked all bottom quartile. Talk about hashtag nailed it. Now, what I actually think is it's not that bad, because what we're actually trying to do is we're going after a niche. We only want the founders and the companies that have got local product market fit that are ready to go internationally, and worse than that, ready to go to the UK or the US. So we actually want to be the VC for the founders in that space. And then when it comes to operational support, there's two types. There's the domain expertise operational support, and we really don't get involved in that. And I can see why founders would rate that lowly, because they've built the business. They know their market, they know their product, that kind of stuff. If you need a VC to come and tell you how to suck eggs, I think you're in trouble. But there are other operational foundations that you're building your business on around the more nebulous, non-product related items around decision-making, organizational structure, scaling up, all of those words where founders without some support, without some frameworks, they're moving around in the dark trying to work this shit out for themselves. But we don't want to come in and tell you what to do on certain things. We want to give you how to go about doing it, because when you start and you're 2 or 3 people, the how needs to change when you're 10 people. Then when you get to 20 people, the how changes again. Then at 50 people, it changes again. And then 100, it changes again. There's a whole life cycle of evolutions. And if you know the road ahead, you can drive faster. So when we talk about operational support, it's really on that. The problem is, from a marketing and a messaging point of view, every VC, every investor helps. And so you end up getting commoditized, and all we can do is let our founders do the talking for us and say, this is what Tribe does.
I think operational support, we know a lot of VCs have a fee-for-service model for talent recruitment.
That's the thing that everybody seems to do. We'll find your people.
Exactly. So I could see a number of founders wouldn't want yet another fee-for-service from the VCs who's invested in them. But I think separating out strategic support or advisory, but it'd be nice to see another subcategory there. And maybe it was actually one and just no one ticked it. But on the international expansion piece, I think as well, if you look at this data set, we have founders in here from pre-seed through to Series GG or whatever it was. And I think there's a sweet spot of those that wouldn't, there's a whole bucket of the founders in those stages who wouldn't even be considering international expansion yet. There's a whole heap that have already done it. And statistically, we're in that sweet spot in the middle of those that are actually looking for that support. So it doesn't surprise me that it's low. And I think the other thing from our experience is, particularly first-time founders tend to think that international expansion's easy. We raise some capital, we go and do it.
We're just going to do the same thing. We run the back office from Australia.
What do you mean? We just expand our Google ads to include more countries. So I'm not surprised that it actually ranks so lowly. And it is one of the common pieces of feedback from our mission participants when we do surveys pre and post, is that they didn't actually realize how much was involved in international expansion, how much can go wrong, how much time and capital is required. So I think partly it's a lack of awareness as well of how critical that support actually is to making them successful.
Jack, out of interest, because you came via university internship and you've now been in the trenches with us and the founders, when you stand back having not been through that operational pathway, but you look at what we do for founders, with founders, how do you describe it to people?
Yeah, the way I describe VC is you either come from the investment banking world or you come ex-entrepreneur, and Tribe's very much come from, you both founded your own companies, so you want to be operational. I look at it as we're pretty much operational partners coming on the journey to help you scale to the US or the UK.
And in that operational partnership, what are the things that you think we bring to the table?
I agree with what you're saying, Don. We're not here to tell you what to do. And I don't just want to regurgitate what you said, but it is actually true. You both got these frameworks and tools that you want to help founders with, but we can only show you when they're ready. So I suppose I don't know. That's probably a bad way of explaining it.
I think you made a really good point the other week, Jack, when you said what we actually do is spend time with the founders. Like that sense of partnership and being in the trenches with them, and that the other things fall out of that. So the value falls out of that. But I think it really was about, that really struck a chord with me, how you articulated that.
Yeah, I think you were telling us to stop saying we add value because it's only the founder that can determine if we've added value. The best we can do is spend time and authentically try and bring tools and frameworks for them to work their shit out and for them to achieve what it is they want to achieve rather than it being something that's done to them.
Agreed, yeah. And something like I think we need to be better at is, in terms of messaging, is Tribe wants to take a concentrated approach. So that means we're not going to have a massive portfolio, and therefore our partners and our team are going to have more time to spend with the founders and hopefully be able to add value.
Spot on.
Good reflection. Are there any other call outs?
I've got one.
Yeah.
So one thing I really loved in this year's report that I haven't noticed in previous reports was they went back to look at investor sentiment expressions from previous years and compare them to what investors actually did. So predictions versus outcomes. And what was interesting for me, the flashback to the 2022 report, the investors predicted, only 24% of investors predicted 23 would be a further downturn. So 77% of investors called it wrong, which goes to show
that is such the human thing, right? Yeah. Things always take longer than we imagined, and we're probably more positive than.
Yeah. But it's a reminder that typically whatever the majority thinks will play out typically doesn't, and especially in financial markets. But I think as well for founders, just to have that awareness that there is often a power disparity or an information disparity between the investor side of the table, the founder side of the table. We're along the roller coaster ride as well, and whatever we believe to be true, probably more than likely isn't. So founders, you have to trust your own instincts and data sets.
Yeah, there's a favoured investor in the ecosystem that calls it how he sees it, and saw him again the other day, and he said, you're too fucking negative. You just got to wake up in the morning and you got to drink the Kool-Aid, and you just got to get out there.
Watch out too, right? The cynic only has to be right once in time.
Yeah. The stop correct. Clock is always right twice a day or some crap.
Yeah,
that's probably the story of my life. On LinkedIn the other day, someone posted about if property prices keep going up the way they have with interest rates, when interest rates start to fall this year, imagine what they're going to do. And I just jumped on there and said, yeah, that's a really valid point. If interest rates were to fall, but because everybody's saying interest rates are going to fall, my view is interest rates are not going to fall, because that's just the world moves in circles of irony. And they came back reinforcing, no, interest rates are going to fall. So I just asked, what data are you using to say that interest rates are going to fall? Because why would interest rates fall if growth is still where it's at? Crickets, nothing back, silence. So people have a real challenge of engaging on anything that tries to change their reality. I'm the same.
I'm the same.
I'm not. You come at me with something, I've got good ways of defending my reality.
Yes, I reject your reality and insert my own.
Yeah. Anything else?
No, other than just, again, a shout out, like, phenomenal report. So valuable for the ecosystem. I really enjoy reading these, and there's so much to take away from there. I feel like I'd probably need to read it several times to get all the value out of it.
Yeah. What I like about it is they then go really deep into some parts. Like they go deep into liquidity, which in prior years has never really been discussed. Secondaries. They go really deep into the gender equity gap with a lot of slides. How do we close that gender equity gap, and can we ever get it to parity? I'm unsure of. So I think we get some guests on to have that conversation. So look, anybody that's really interested, go in there and have a look. And why? Just understand the state of an environment. That's all. Don't put too much weight on it. If you're an entrepreneur that wants to achieve greatness, you've got to shed reality a bit and just do the impossible. Cake then released a report, as did PitchBook. So it's like the week of big reports.
Yeah, so shout out to Cake Equity on there. The State of Aussie Startup Employee Equity, which had some really good insights for founders who are looking at employee share schemes and incentivizing employee behavior through the use of equity. And no surprise, maybe it is a bit surprising, but 61% of surveyed employees say they find equity an important factor in accepting a role with a startup. I actually thought that would be high, but I guess they're placing it as an important factor. It was interesting highlighting the challenges that only 50% of employees actually know what their equity is worth.
Which I think is that in itself is a challenging one, that even if you've raised, what is it, the Schroders cat one,
Yeah.
is that if there's a cat in the box or something, that it's either dead or alive or both at the same time.
Yeah, or trying to measure a photon and these subatomic particles. You can either know where they are or what form they are, but you can't know two things at once. And I think that's definitely plays out here.
I mean, a startup's value is when you can either get a secondary liquidity event. It's probably helpful knowing that actually there's potential value here, and maybe that's really what's to take away from it, that if you don't know the potential value of something, then how do you care for it? How do you go that extra mile? How do you say, shit, there's really something here? And if you've got a group of people that know the value potentially versus a group that doesn't know the value potentially, I bet you the outcomes of the first group are better, even if you work on things like values and alignment and all of that jazz.
Yeah.
But do you think that, like, traditionally for a cap table, it's been managed on Excel? So when the fundraising process is handled, it's normally the founder driving that. So the employees are too busy. They're busy driving the business. So you actually don't know what you're about, like what the valuation uplift actually is. And that's why something like Cake, which is a digital platform, right? It's all managed there. You can sign on as an employee and you can see any uplift in the valuation because it's a dashboard.
And I think it goes further than that. It's before Cake and you're raising from your investors. You're just trying to get your investors your capital. And I remember back in my day, the idea of employee options and all of that was like complex and they had to be really special.
Yeah.
Now, with something like Cake, because it's so easy, I believe they're creating new demand. Because if you're doing a cap raise and you're using Cake and you want to retain someone, with a few clicks, you can set up your vesting schedule. You can do all those things. It's too easy not to engage people, even in something. And so if someone's going, okay, prior to the raise, I got $10,000 notionally of convertible options. We've done this raise, and then now it's worth 40,000 or whatever. I think that helps create a psychology
I think
within the company. And when there are times when people are going to throw their toys out of the cot and crack the shits, they maybe put some value on it. Not always, but maybe sometimes.
Yeah, I think they're really good points. The other takeaway for me in this one, because I get asked a lot, what should our vesting schedule be? And they pulled together some data saying 56% of Aussie startups apply a 1-year cliff followed by a 3-year vesting period. And what was interesting, I shared that on LinkedIn, and then a couple of US founders I know hit me up, some on the post and some direct, just asking why it wasn't a 4-year vesting period after the 1-year cliff, because that's the actual standard in the US. And I'm not sure what drives those nuances of difference here versus there.
Have you ever heard of a 2 or a 4-year strategic plan?
No.
They're 1, 3, or 5, or
That's
10.
true.
There's just something about 2 and 4, even numbers. Here's my 1-year plan, my 3-year plan, my 5-year plan. So maybe that's the pattern. That's what we should do. Maybe that's our differentiator. At Tribe, we help you create 2 and 4 year, 2, 4, and 8-year plans.
One of the other stats, only 34% of founders think they communicate the value of equity effectively. And I think that this is an important point, right? Because having an ESOP is super valuable for a team, especially we've seen in a potential investment, like any creative team or even devs, they've got the capability in-house to go on freelance. So there needs to be a higher justification for joining the mission and coming on this journey. And I think ESOP allows that. Like there's more of a reason for an employee to buy into the mission.
Yeah, it's a great point. And it's interesting for me because I often see founders who are perhaps significantly underpaid and putting in a ton of sweat equity, and then seeing staff who are motivated by the immediate financial return, and there's a frustration there for the founders. It's like, why don't you buy into my mission? I want to change the world, and don't you get it? And so I think, for founders, that was an interesting stat for me because the other part of that stat, Jack, 45% of the employees felt that their employers didn't communicate it correct. So the founders actually feel it more than the employees, that miscommunication in value. But it is a reminder for founders to have these structures in place, to have these incentives in place to drive those behavioral outcomes.
Yeah, no, absolutely. And equity and options and shares is an incredibly powerful thing. Look at what Elon's been able to achieve through the granting of shares and options to his board. Like, you can buy people.
Absolutely. And reading the Capital Brief article and more into that, like a number of board members picked up significant, multi-million, $100 million bonuses.
They have exchanged the ideals and values of corporate governance for a big personal series of checks. Like, it's not rocket science.
I think in this particular case, there's no independence of the board members. They're all, drinking off the gravy train.
That's the issue. They're captured. They've been made incredibly wealthy. That's the playing field.
I can't remember if it was the same article or maybe it was another one I read. This sense of we have to do what he says, otherwise we lose the gravy train of all these bonuses. And when you look at what they've been paid, it's an outlier in a data set of what board members make. It's an outlier by a mile. I don't think they were independent. I think there's such a conflicted board, and I see that as being a bigger issue here.
But anyway, speaking of wacky things where people make outrageous sums of money, you see that thing where a deep fake conference call?
Oh, we are entering a scary world.
Holy shit.
So deep fake an executive team to get an employee to transfer funds, and they lost, what did they lose? 25 mil?
25.6 million. Far out.
And this is just beginning, right? And even because my mum she gets bombarded with these types of scams and everything. Can you imagine a world where this just goes mainstream to consumers? Like, Mara and I were joking this morning that as part of our tribe policy, we need a code word so that to avoid a deep fake where instructions are given to do something that just is fraudulent.
I don't think that's silly. In the family office, we've had a number of attacks, and then one person from within there sent a video from Facebook going, I think this is a scam, but should we just throw some money in it anyway? I'm like, what?
I had the exact. So my grandma called me and she was saying she watched a video of Gina Reinhart on the news saying you should invest money in this automatic trading platform. And she goes, Jack, can you review it? Because I'm going to put some money in. She's never invested in her life. And I was like, I can tell you right now, it's got to be a scam. Why would Gina Reinhart, who is in the mining sector, tell you to put money in an automatic trading platform? She's like, Jack, Gina said she wants all Australians to be wealthy like her. Like, yeah, she's not saying invest in the mining stock. She's saying automatic trading platform.
It is scary.
So did your the childcare get hit with the same one, Don, about Gina Reinhart?
No, this one was, I think it was Dick Smith.
Yeah, man.
But it's brands, it's people that
so
people
crazy.
are good. And when you look at it objectively, this is definitely a deep fake. But soon you won't be able to tell. And the immediate thought that because we transfer big sums of money doing different things.
Yeah.
And it's done with a phone call afterwards. I'll generally phone if it's over a certain amount. I'll call the final button pusher from within the family just to say I've okayed this. But soon that won't be enough.
No, I agree. And in all seriousness, for us, we have a 2-stage process when we're deploying funds, double verification. But voice and face aren't enough anymore. It's just deep fakes is a real danger. And then the other challenge, deep fake, and we think we're able to detect what's real and what's not. And then we have crazy stories going on in the ecosystem of things that you just can't believe are true, which is my little way of segueing into the co-founder, Adam Neumann, co-founder of WeWork, trying to make a revival and buy it back.
Guess who's back again? Adam's back. Wow. See, this is, look, and you chuckle on one hand, but on the other, a mindset that says, I don't care what the rest of the world thinks. I'm just going to give it a shot.
I'm going to make it work. I believe I can.
With my $1 billion of money, but from hey, it wasn't illegal. Irrational, mostly men, gave him that money.
Yep. So shout out to Letter of Intent, like their little newsletter.
How good
I
is it?
love that last line of, "We thought we crashed" was the last we'd hear of the eccentric Neumann. Turns out some leopards can't change their spots. This is a really good little article.
Yeah. Look, nobody's died in self-driving crashes under Adam's watch, so I'm less caring of him. But yeah, it is. When I saw that, I was like, wow, some people just don't give up. But has the model not demonstrated itself wrong, taking long-term leases with big capital costs and then selling
That's the bit I'm interested in.
short-term leases to dodgy credit risks?
Yeah. What's going to be different this time? What is the model tweak that will make it work this time round?
Oh, I'd be intrigued to see what happens. But an Aussie company that the model is clearly working and has achieved the 3 comma club, so quarterly revenue over $100 million, is Atlassian.
Yeah, far out. But it still didn't make the stock market happy.
No, it is a good lesson that expectations in the stock market are all that matters, because the stock market wanted more.
Yeah.
Please, sir, I want some more. And the shares dropped 8%. But I would argue Atlassian and then the founders and then that transition of capital into Blackbird, and then I would argue that Atlassian disproportionately was the thing that really kicked off a lot of the stuff that's in that cut through ventures report. Because then on the back of Canva, reputations were then built and more. I don't want to put everything there because there were angel groups and all of that, but I don't know. I just disproportionately feel that Aussie company and the founders were a big driver of this ecosystem.
Oh no, absolutely. The founders were definitely a key part of StartMate in its heyday. And then the other thing Jack and I have observed with deal flow is you look at companies like Atlassian or Technology One, the number of decks we are getting from staff members of those companies who've now spun out to start their own venture.
Yeah.
And this was always the point. Like Kaufman Foundation did some research on this in the US. Like those big tech giants actually spawn out more startups. So it's a great sign of the ecosystem when we start seeing that kind of, not just recycling of entrepreneurs, but these are engineers, techs, sometimes even just more traditional operational staff now spinning out to form ventures. And Atlassian's definitely in that category.
Because you need capital, but you also need that operational experience. You need, not always, I'm not saying every company, I'm saying an ecosystem as a whole. If you can get a good balance of fresh, irrationally exude energy coupled with operators, I think that's the complementary teams you're after.
Yeah, absolutely.
And another sort of spin out had been Afterpay. Afterpay had set up Touch Ventures after their $39 billion exit. But again, in Capital Brief, the heading is wind the fucking thing up. Investors gun for Afterpay's struggling VC arm. Now, when I first read it, I thought it was Torch Ventures. I thought, what a perfect name for what's occurred. Torching the ventures. But no, it's actually Touch Ventures. And that share price is quite interesting. I can understand a multi-alternative asset investor potentially having a listed future, although I think there have been some scenarios that highlight why being listed in that alternatives in liquid space is just really difficult.
Yeah.
It's not a path I'd want to tread. But then to just have a VC thing as a listed entity, yeah, I don't think that was ever going to work, putting aside, maybe if they'd made some good investments, then, but there's no, I think it would be a lumpy as shit thing that's always hard.
No, totally agree. But yeah, there was a lot taken from this one. Afterpay's acquisition for $39 billion and now recently laying off 1,000 staff. The original thesis of their fund, it makes some sense, like the fintech aspect, the payments aspect, the value of the network that they have, all these things that would be preached as the extra value add beyond the capital. But incredibly...
Got the timing wrong.
They've torched it, to your point.
They took money at the peak when they sold it to set up a VC at the peak that invested in all these things at the peak. But then when I look at their logos, the thing that jumps out to me is these are companies that sold things for 80 cents that cost $1, which I think is what Bill Gurley constantly pulls out. Anyone can get a bit of traction doing that. But now when you need to sell things for $1 that only cost you 80 cents and you've blown up all that capital, too bad.
Yeah. And going back to that what we were talking about before, here was a big fund, like a large amount of capital, big brands in the mix, and still failed to deliver. So I think it is easy. I mean, look, from a founder's perspective who took capital, probably happy days. They've taken some capital.
I don't know. I think a lot of these founders, I think it's that Silicon Valley episode where it's, I could have taken less. Had you have taken less, the whole journey would probably play out different because you had to teach yourself things that capital doesn't teach you.
Yeah, no, it's so true. So
when you look at Block though, a $39 billion acquisition of Afterpay, which looks like it's going to be worth sweet FA, but a investment company we really respect, TDM Capital, who's really bullish on Block. I wonder if they managed to get some money out, because when they invested, it was about $67 back in when they invested, and then almost hits 300, and now we're back to the 67. Yep. Now their thesis is all around some of the aspects of the 7 powers of Hamilton Helmer, so around network effects and scale economies, and they really like the business. And when you have a look at the gross profit, like that is an incredibly professional, what is wrong
Profitable.
with my brain today?
Profitable.
It's a good graph.
Goes up and to the right.
Up and to the right in the massive direction. But the share price has gone down and to the right. So it's going to be interesting to see if the market is wrong here and there is this underlying durable asset. And maybe what's happened is that the Afterpay acquisition was just a fuck up, and what comes out of this is going to be something great. But I guess as a CEO and like Jack Dorsey scares me. I do believe Scott Galloway's view of the yoga babble bullshit crowd, and Jack's at the top of that. And so when you look at what happened with Twitter and what Twitter could have been, and notwithstanding Elon coming and then really fucking it up, like, I don't know. TDM really are big on values and culture and all of that. It's going to be interesting to see how that plays out, because when I look at it and hearing what's happening in the culture and just the leadership, I don't get the same feeling.
Yeah, I don't. Obviously, we don't have all the information that they would have, but I do wonder I'd be curious if they did sell something off the table at the peak, and they would have done well if they had. And I'd be curious to see what their thesis is on it now, like what that update is on what they see.
Yeah. Let's see it play out. Do we go into Appen? Is there anything relevant to Appen, or do we go into the fact that B2B tailwinds are?
Yeah, I think more the B2B. Appen,
it's a bit.
I didn't really
it's a bit of a
take
nothing.
much. Yeah.
So what? We'll delete that.
Sweet.
But there was another post during the week that really made me think, and I'll just pull it up here. It was from a partner at A16Z, Anne Lee Skates. And she put forward that there's been all of these structural reasons why people like us have gotten into B2B, and puts forward some interesting ideas as to why that has been the case, and that maybe B2C is going to see a bit of a resurgence that it hasn't seen in the last 10 years. Did you get a chance to have a look at that?
Yeah. And I think cyclically, look, it makes sense. And I've noticed more VCs and investors moving back to B2B during this phase of the cycle. But yeah, I think B2C will make a resurgence. There's those that predict the world is heading towards P2P, like H2H, human to human, and what is the need for a business as an intermediary. I disagree with that thesis. I think there'll always be a B2B segment. But yeah, I do think it'll swing the cycle for B2C. I don't think these things are mutually exclusive, but I think the cycle for B2C will absolutely come back. Yeah,
I think humans need an intermediary. Socialism hasn't really stacked up all that well. And some of the points that she makes is that B2B is more about known unknowns, and that you can get earlier traction in revenue, and it's a bit easier. And I'd agree.
Yeah.
And as someone, I'm happy taking an easier path. The remit from our shareholders to create returns. I don't need to be a hero trying to back things with unknown unknowns, and that's where B2C tends to be. And our experience is B2B. So I think it sets us up. But I think it was just interesting that she then also highlighted that there'd been a flywheel of when money comes out of some of these cloud type businesses, it tends to go back to where it knows, and that's back into B2B. Whereas it's been generationally, there hasn't been the B2C side to do that. But what she's saying is that the AI revolution is really rails to run on for B2C to create some amazing things. And I think that's probably right. Where we're going to continue to play is on that B2B.
Yeah, we're just playing with what we know.
And the ultimate B2C. Sorry, Jack.
No, I didn't say anything.
That's right.
Do you want to say something?
No, I agree. I agree with everything in that article.
I do find it funny with some B2B commentary. They've just discovered these things about B2B. It's let me write an article telling you about B2B. Okay.
B2B I think is easier, and it's probably for dumber people, and so that works well for me.
Yeah, it was perfect for us.
There's another person in the ecosystem that always throws shade at the B2B space because it lacks all of these things. I'm like, I'm not that intelligent. Like what?
We are simple folk doing simple things.
And that
doesn't mean it's not hard, but it's simple.
So what do you want me to do? But the ultimate B2C company, Apple, they've released their Vision Pro. Have you seen those?
Yes. Oh, you can't avoid all the memes and hilarious takes, and it's so much fun to watch. Is this really where we're heading as a society? We're all going to be wearing these things around the street?
I guess if you get to a point where you don't fear the judgment of others, probably. But I am going to abuse my position in the family office and whip out the card and get one for R&D purposes.
I doubt
I'm going to have reached a state of enlightenment despite the journey that I'm on, where I wouldn't feel judged or like a total wanker in public with those on.
I'm predicting Don will wear one on a podcast soon.
Can we please get a photo done when you get it? You sit in the office.
But this is the thing that, why are these going to succeed when VR hasn't?
Yeah.
And I guess it's the productivity element. Where I'm really seeing some of the stuff is in health tech and engineering and all of that. I can actually see commercial uses potentially here that I couldn't see with VR. And so I'm interested, if there is a productivity thing here, can I see myself using them inside my own home because I can do things better or faster? Probably. My office is outside of the home. My wife's judgment lives inside the home. So within my own office, it's a judgment-free zone.
Right. So is the sell for one of these done productivity?
Not at the moment. I think like any tech diffusion curve, I think the early adopters are those that just love the tech. They want to be across the latest tech. So we're seeing the young tech savvy adopting this. I don't think they've crossed the chasm yet where there's true value recognition for productivity or any meaningful value yet. But I think this is probably the closest we've seen based on some of the demonstrations I've seen, like particularly health tech. For me, the one that did make me want to buy was seeing the Formula One app, where you can watch on the screen and it projects the actual racetrack with all the drivers, and you can pull up all this telemetry data. Yeah. And that was actually pretty cool. But
that's what I said. It's like a new medium. Like instead of watching on a screen, you just throw on the headset. But the price point right now is, it's not justified for how much more it is, but the experience you get by throwing that on and then watching a movie or going about that seems to be 10x.
Yes, I think you're definitely right. But remember when 3D TVs came out?
Yeah.
I bought one. On.
Yeah, and I think at the time I bought 20 pairs of glasses. So like when I had people over, we could all use it. Like when I say I'm going to buy one, the chances are that it's going to end up in the drawer within about 8 days. Like, because I love to buy the tech and experiment, but then I never seem to last with it. And so if the experience like that is enough to be cool, like that 3D movie was pretty cool, but then nobody gave a shit. So it's going to have to be a real evolution. But yeah, Jack, maybe you're right. Watching something like that, like unfortunately I don't have T Swift tickets, but if she brings out a version of that in full spatial awareness, like that alone is enough to justify the $6,500 for me. But
is that what it is? $6,500 for one of these?
Yeah. It's R&D, Jack. I'm doing research and development on behalf of all the different assets that we have in the group. I can't preside over the group unless I know what's happening. Don't look at me like that.
No, it's totally justified.
But
you're a tech BC. You have to be across the latest tech.
I just really want to see this photo, Don. Me with the headset on.
Mowing the lawn. On the...
But yeah, I think I don't feel this particular piece of hardware will cross the chasm into mass adoption, but it is an inevitability, right? That we will head towards ubiquitous human-computer interface where this stuff's just embedded in our brains, and we live in this virtual augmented reality, and information's pulled up instantaneously. It's on that trend, but I don't think this will be the product that ultimately wins. But I think it's a step closer. But I think in the meantime, it's going to make for a lot of funny, hilarious memes and probably people getting themselves into all sorts of
damaging of reputations.
Yeah. Don, do you think you'll bring it to London for the plane?
Oh, no, he has to.
Okay, Jack, perfect use case. So you're too poor to afford economy. You're trying to make the journey a little less shit.
So you got the VR headset looking at...
Just put the VR headset on.
You're in business, but you're really in economy.
Where you choose like the things like, I want to be someone. And hello, Mr. McKenzie. Yeah, I think peak Don's got a problem is if you spot me cruising around the property on the quad or something with the Apple. I think that's when I've lost it.
That's when we need to have a chat.
Yeah, cool. But I have a feeling, Jack, we probably need to have a chat already. But yeah, I think. But Apple's brand has taken off. Yeah. Apple's brand is like the new kid on the street. Apple's got a very strong brand that a lot of word of mouth occurs. And it just, as the final thing to talk about, there was a post from Adam Robinson, who's the CEO of retention.com, that there was just a line that really struck me, that if you have a product that isn't growing at some point by word of mouth, you're already dead.
Yeah, it's a great line.
And that just struck me as so true, that if you don't have a core value proposition that has that organic wildfire aspect to it, life's really hard. And I'm not sure that, I think marketing accelerates some of these things, but if you don't have the word of mouth aspect, difficult.
Yeah, and for those who didn't see it, so this was the CEO of retention.com, Adam Robinson. He had so many great lines in there, like describing the feeling of product market fit, and it's just like you can't describe it until you actually know it.
Yeah, so retention.com is fully bootstrapped, and I'm fairly sure they've tipped over the 20 million ARR. Like, they're a beast of a company.
Yeah, bloody good. But the line, so much of our identity and ego are tied to our amazing products and businesses that it's very difficult to realize when you don't have product market fit.
No, I love it.
And we see this so much, especially tech founders in love with their product. And I get it. I've been there. but yeah, it is hard when you're that fixated on the product side to actually realize what product market fit truly is.
And you can smell it in a deck pretty quick. Last week, I think we referenced what we like in decks and what we don't like. And I think we agreed that really long decks that just constantly talk about the product are not efficient or effective. But you can tell a deck where people have transcended just their product and understand they've got to build a business when they go into go-to-market aspects, how they generate leads, how they convert leads, how they find their prospects, what they've learned. Like that, when you're reading that deck, you start to go, oh, hang on a minute, there's somebody here that really has potential.
Yeah. Yeah, when I think of particularly two that we're looking at the moment through the IC, like the product is secondary to all the other business fundamentals and metrics and that go-to-market strategy and their understanding of their market. And it's later in the process where you start getting deep into the product.
Yeah. So product market fit, one example of one of the ones, they received a single order that was 25% of last year's revenue.
Yeah.
Out of the blue. And word of mouth has started to take and all that jazz. And so product market fit is a really difficult one because people talk about it as something that you can systemically spreadsheet your way into, but actually it's something in hindsight you can evaluate. The main thing is if you don't have product market fit, you know you don't have product market fit because, trust us, you know if you do have product market fit. So if you feel that you don't, so use those signals to be adjusting messaging, value proposition, all of those things, rather than searching for an arbitrary feeling that doesn't arrive until the results arrive.
Yeah, there's an analogy for me in surfing, like when you actually catch that first wave, like a proper wave, and you drop down on the wave, and that feeling of it's completely different to just catching the whitewash or anything else. But then you've got to stay on the wave. Like it's not just this one-off thing that happens. You've got to then ride that wave and continue to adjust as you go. And you hope that you caught the right one. You found product market fit where there's a decent TAM and longevity to that market, and it's not just going to wash out and dump you on the shore or something. So yeah, it's a tough one. I remember Kim Hansen from Cake on the London mission talking about exactly this point. It's like everyone talks about you just get to product market fit and then it's happy days. It's like, no, it continues. You've got to continue to just finesse the nuances of product market fit as you go as well.
Yeah, absolutely.
The last little quote from that one, which I love, just to throw out there: cheap, abundant capital has kept mediocre SaaS alive for far too long. I think that describes the last year pretty well.
True statement, unfortunately. And we don't, as founders ourselves, we don't say these things to try and elicit pain or to try and come across too arrogant. It's to try and elicit motivation. And going back to one of those episodes earlier, don't get bitter, get better. Yeah. And the reality is, mediocrity can be easily hidden through money and resources, and the people that can shake off mediocrity are about to be found in 2024, I think.
Agree.
And whether you think you can or you think you can't, you're probably right. I think we should end on a nice nauseating note like that.
Yeah, I loved it. Yoda Don.
So, what are we looking forward to?
I got the New Zealand Waitangi Day today with the New Zealand government this afternoon. So looking forward to that.
It's a really good food, Aaron. It's all the NZ produce. So
I can't wait. I'm looking forward to it.
I'm looking forward. What am I looking forward to? I'm looking forward to, I've got another good weather for the rest of this week. So looking forward to getting to the beach again on the weekend.
Hitting the beach. Lucky you. Yeah, I'm going to be in the garden. Got some friends coming over.
Headset on.
They haven't arrived yet, Jack.
Yeah, these are friends. He means these virtual avatars that he's talking to.
Yeah. What's Dad doing in the paddock sitting there? Leave Dad alone. I'm just looking forward to it. Just in general, it is what I'm looking forward to. All right. See you on the flippy dippy.
See you guys.
See you then.